Let's dive into a story that's got it all: absolutely staggering sums of money, a hidden corner of the global banking system, and, well, the deliberate choice to just look the other way. Just look at that number: $150 million. What does a figure like that even mean? Is it the haul from a blockbuster movie? Maybe a hot new tech company's first year profit? Nope, not even close. That is the price of a mistake.
Yeah, that's right. It's a penalty, a nine-figure slap on the wrist for one of the world's biggest banks because of some absolutely massive compliance failures. It's the bill that comes due when you ignore warning after warning and just let billions in shady money flow right through your system.
So you gotta ask, right? How on earth does something like this happen? What is this sort of hidden system we're talking about? And how did it create a blind spot so huge that you could literally drive a truck full of cash right through it without anyone batting an eye? Okay, so our story really gets going in July of 2020. That's when the New York State Department of Financial Services, let's just call them the DFS, slammed Deutsche Bank with that huge $150 million penalty. And the reason? Well, it all came down to a total failure to keep an eye on their relationships with two specific banks: Danske Bank Estonia and FBME Bank. But, to really get how a fine this big is even possible, we need to zoom out a bit. We've got to look at the system itself. There's this fundamental piece of global finance that has a built-in weakness: a massive global blind spot. And that system is called correspondent banking. So, what is it? Basically, it's where a huge international bank acts as a kind of middleman for a smaller, local bank in a different country. You can almost think of it as a bank for other banks. Here, let me put it this way. Your local bank, say down the street, probably doesn't have branches all over the world, right? Of course not. But what if you need to send money to someone in, I don't know, Germany? Well, your bank can use a big correspondent bank, like Deutsche Bank in this case, to get that transaction done for you. It's basically the plumbing that makes global finance work. Okay, but here's the catch. This is where the whole thing gets risky. The big bank, the correspondent, they know their client, that's the smaller bank, but they have pretty much zero visibility into who the smaller bank's customers are. This is what the industry calls the know your customer's customer problem. And believe me, it is a massive information gap. And look, the official report on this puts it pretty bluntly. It says the bank is providing services for people and companies for which it has neither verified the identities nor obtained any firsthand knowledge. I mean, just think about that. That is a gigantic risk baked right into the system. So what does that actually mean? Well, it creates some major vulnerabilities. For one, you can't do your due diligence on the person at the end of the chain. You have very little data to spot shady activity. You're basically just forced to trust that the other bank is doing its job. And then you have this thing called nesting. It's like a Russian doll of risk, where a bank's client is actually another bank, hiding its own customers another layer deep. The whole system is built on trust, which makes it totally ripe for abuse. Okay, so now that we know the risks, let's see how this all went down in the real world. We're going to look at the timeline of how all those theoretical problems became a very real multi-billion-dollar nightmare for Deutsche Bank. And here's the kicker. This was not a surprise. Not at all. Deutsche Bank's own systems flagged both Danske Bank Estonia and FBME Bank as high risk. They knew right from the very beginning that they were playing with fire. Just look at this. The first red flags about FBME popped up way back in 2005. Danske Bank was flagged the second they started working with them in 2007. By 2010, Danske's internal risk score was at the highest possible level. Then in 2013, the bank's own compliance staff formally said, hey, we need to end this relationship. And still, nothing happened until 2015. We're talking a full decade of documented warnings being completely ignored. So what was going on during that decade of doing nothing? Well, just a casual $150 billion flowed from Danske Estonia through Deutsche Bank. That's billion with a B. And between just those two clients, the bank itself tagged over 1,000 transactions as suspicious. The sheer scale of this is it's mind-boggling. And we're not talking about abstract numbers on a screen here. The DFS investigation connected these billions to some very real and very serious players. We're talking Russian oligarchs and even a company whose owner had ties to a Syrian military research group. This is the kind of money we're dealing with. So, okay, eventually the relationships ended and the massive fine was paid. But that leaves us with the bigger questions, doesn't it? Why did everything break down so spectacularly? And what are the lessons we're supposed to take away from this whole mess? Well, the DFS report really breaks it down into three clear points of failure. First, the bank just didn't have clear rules for when to say enough is enough and cut a risky client loose. Second, the employees on the ground had no real practical guidance on how to figure out who was really behind the money. And third, and this is the big one, management just flat out ignored the constant warnings coming from their own compliance people.
And really, that's the heart of the matter. The problem wasn't a lack of information. It wasn't that they didn't see the red flags. In fact, their systems worked perfectly. They were screaming about the problem for years. The real failure here was a failure of will at the institutional level. The alarms were sounding, and nobody in charge chose to listen.
This whole scandal serves as a really powerful and obviously very expensive lesson for the entire banking world. It shows that compliance can't just be a box you tick. It needs real active support from senior management. Ignoring warnings leads to huge financial and reputational damage. And when you have a high-risk client, you need to be all over it constantly, not just slap a label on a file and forget about it.